Hey everybody, it's JJ Conway. I'm super excited to be here with you live. If you are watching this live, then you know I am super late. And that's because, and you also can tell that the sound and video quality is not what it usually is. And that's because I foolishly thought that with my friend, one of my favorite people in the Air Force getting married today, I foolishly thought I could slip out of the reception and go find one of those pretty spaces over Caesar's Palace and do a quick fireside chat and then slip back into the reception. So I didn't pack my good camera and I'm operating off of hotel Wi-Fi. So we'll see how that goes. But if I can get it to work, then I don't want to miss an opportunity to answer some questions that were sent in. One of these questions came from our monthly group coaching call. So if you're available at 11 Central Tuesdays, I encourage you to jump in at that call. You can get information about that through the link at the bottom of the screen there, jjclink.com/group. All right. So my first question for today is whether or not I should take a HELOC to buy a rent home. This is coming up really popular now. Not as popular as it was maybe a year ago when the interest rates were lower, but I'm still seeing a lot of it because with the rising interest rates, now the hard money lenders are charging higher rates. And so people are wondering, can they use the equity in their own home to get into real estate investing? And I'm going to caveat my answer by saying that's exactly what my mother-in-law did, my ex-mother-in-law, who I still consider my mother-in-law. That's exactly what she did. She bought a house for pennies on the dollar at a tax sale, which already breaks the mold because usually at a tax sale, the investor makes interest, not ends up with a property. So she already broke the mold on that. And then she used equity from that to buy the next, and equity from paid that down some, equity from that to buy the next, and so on and so forth. And she bought very wisely. And she is what you would consider a multimillionaire today. So I can't say that never works because that's how I saw somebody do it. And that's why I ended up in all that 800 something $1,000 of debt, even though we got out of debt the first time, because the allure of real estate debt was amazing because it worked for her and it worked for other people who got up at the real estate meetings and talked to us about real estate. And honestly, now that I can look back on it and see who's still in the game and who isn't, I don't think it worked for all those people who were saying it worked. They just said it worked. They felt in the moment it worked because they were moving forward. But so many of those people have gotten out of the game, or they've sold off their properties, or they've lost so much. So be very careful who you listen to. And I'm going to explain why the HELOC is, in my opinion, not such a great idea. Now, again, clearly I'm not in my office, so I'm going to try to draw this out, but it may not be easy. It may not be effective, but we're going to give it a shot. All right. So the thing about the market is the market goes up and down and 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 up and down. And in a general trend line, can you see that? In a general trend line, the general trend of the market is to go up. Okay, the general trend of the market is to go up. But in any given time period, you could have a big upswing and you could have a big loss, okay? And the problem with these is you don't know you're in a loss until you're in it. And everybody can see that the market is hot and the market is hot and everything is climbing and climbing. And somebody gets a property under contract today and they turn around and put it on the market for 50,000 more tomorrow. Don't even do anything to it. Like I saw that in Stephenville. Somebody bought a property I was looking at for $230. And actually they did. You know what? I'm not going to say they didn't do anything. They put about $100 worth of paint and maybe $500 worth of carpet on that thing, and then tried to sell it for $290. It's still for sale. Why? Because that's ridiculous. So, especially since I wanted it for my office. But in any event, the market goes up and down, up and down. The thing is you would think that all of us as investors would say, yeah, I'm going to buy right here. I'm going to buy all my property right here, and I'm going to sell it here, or ride it a little bit and sell it way up there, right? Like if we could do that, then buy low, sell high, right? Like if we could do that, we would. But the problem is you don't know when this market is climbing and climbing and climbing up. Let's see if I can do this back without seeing it. When this market is climbing and climbing and climbing, you don't know when it's going to hit this and start going down until you're about here. I'm circling that and I'm writing no. Now, for you engineering scientists, mathematicians, and purists out there, this is not a very accurate graph, but this is depicting the concept. Once we get right about there, that's when we realize, oh no, the market's crashing. And when it crashes, it crashes. And with the superficially rising prices that we're seeing right now, and the interest rates rising up, it may be tempting to think, oh, I'm going to ride this. Real estate always recovers. Some people are teaching that real estate always doubles its value in 10. I'm hearing that from a lot of different gurus right now, that real estate always doubles its value in 10 years. And I'm here to tell you that doesn't always happen. The one that we had that was $225,000 upside down after the last crash still has not recovered. So if you ask me, should you take a HELOC against your primary home and put it into real estate, which, I love real estate, but we don't know if you're going to be able to pull that money out when you need it. I'm not going to tell you to take that risk because it's a risk. What you're risking when you do that is you're risking pulling the money out of your home that you really earned through savings and then needing it when the market is down here. But now you can't sell the other house that you put the money into. You can't sell that house and use it to do anything for your family. Okay. So for me, that's a big risk. And I'm going to recommend no, that you don't pull from your primary home for a HELOC to put on another home. Oh, well, JJ, what about pulling from my rent homes? Because, my rent homes are all on LLCs. So that reduces my liability. So if something goes wrong, they can't take my primary home. Well, you can play that game if you want to. And I would talk to a CPA before you decide that, because sometimes we think we're safe and protected with these LLCs and we're not. I had somebody that I was talking to the other day, and I don't know the rules in the state where they have an LLC, but most states, a single member LLC provides you no legal protection. So I'm not a lawyer and I'm not a CPA. I don't pretend to be one, and I'm too cute to go to jail. So make sure you go and ask your legal counsel if the rules of your state actually give you protection from a one-member LLC. The states where I have LLCs, they pass through to my own personal taxes. And guess what? They also pass through my own personal liability. Now, my liability is up to and including what's held by that LLC, but that doesn't mean people can't still go after me if they think I have other stuff, which I'm still rebuilding. So I'm not too worried about it right now. But you better believe that there's not very much else that's ever going to be bought in the name of JJ Conway. And for that reason, all right? So that's the thing. Like if you need the money, the equity in your house, you can't count on the market to keep going up and up and up and up. But what you can count on is if you find other ways to buy your property, such as subject to or using owner finance or doing certain kinds of wraps or things like that, then you can acquire property without taking on more debt of your own. And you can also preserve your primary residence at the same time. Okay, great question. Thank you for asking. I hope I didn't trouble. And someone else, they weren't asking me this specifically. This isn't one that came to me, and I'm trying to think of where did I hear this. I either heard it from somebody or I was reading it on a forum, but someone was looking at, oh, I know where it was. Y'all, if you all are in the Maryland area and actually anywhere on Zoom, I encourage you to look up Sherman Ragland, because that's the real estate mentor who helped me learn how to do my first deal. And he has an excellent 21 days program to help you do your first deal, which is I kind of model mine off of his, but I put my own little flavor on it because y'all know I don't like debt. But it was in one of his classes, and I mean, phenomenal mentoring at the hands of the master, right? And in the 21 days class, it's 21 days boot camp. I think it's actually free. So, that's something to go into if you're in that area, or if you can be online, because he does it online as well. But in the class, somebody was looking at buying a property, and he astutely warned them about their carrying costs. See, in our mind, we think, oh, I'm going to go get this loan, and they're going to pay for all my rehab, and then I'm going to get it all done, and then I'm going to sell it, and I'm going to make $1 million, right? But the thing is, let's say you're buying a raggedy old property in a high income area, so the after repaired value of those properties is like $2 million, right? And you're getting this property for $700. This is not the example that was used. I'm just making these numbers up. But you're getting the property for like $700,000, and it's going to cost you $400,000 or $500,000 to renovate it. You're still into that property for 1.2, 1.1. You're going to turn around and sell it for $2 million. That's like an $800,000, $900,000 payday. I would do that deal all day long if I've got the funds to actually acquire the property in the first place. And what people think sometimes is, oh, I'm going to get a hard money loan like all the other real estate investors. Okay, great. You've got a hard money loan at a 12, 15, 20% annual interest rate. Okay. And now what are you paying every month? What is your carrying cost? See, your real estate cost isn't just the reno cost. Your real estate cost isn't just the acquisition. Your real estate cost isn't just the earnest money you have to put down to make the offer. You've also got to consider the whole time you're renovating, you're paying interest to that hard money lender, which in this situation, that could be $7,000 a month, $10,000 a month. Okay. So you're paying that. You're paying gas, you're paying water, you're paying electric. It's not free. Now, if you're getting a little old shack, off of a little old shack off of Ollie or McCart or something, and it's $40,000, and it's going to cost you $10,000 to renovate it. Well, your carrying costs on that might be $300 or $400 a month, and a lot of us waste $300 or $400 a month in McDonald's, Pizza Hut, what have you. Okay, so I could see you doing that. I still don't want you to take on debt, but I could see it playing out. But when we get to these bigger dollar numbers, we have to make sure, even at the small ones, we have to make sure we include our carrying costs and our holding costs into the whole equation. And then you want to make sure there's enough money for you to get paid. There has to be something left on the table for you to get paid, because we always find, we don't always find, but a lot of times one of the biggest mistakes I find new investors make is they're so excited about fixing and flipping the property, and then the property doesn't really carry much, that they haven't built in their profit into their original equations. And so we're going to talk about how to actually calculate all that out in our next real estate class. Oh, I never did my little intro. Yeah, I'm so happy you're here. It's the first Thursday. That's our fireside chat. The second Thursday is our 7-figure business building. I had to bump it up. Now we're all at 6 figures, so now we got to bump it up to 7 figures. We're chasing that 7 figures, and then it'll be higher than that. But that actually leads into my second question. But third Thursday is our real estate, and then fourth Thursday is our empowered entrepreneur. And so when we get to our third Thursday, we will talk more in depth about real estate questions. But I did want to go ahead and answer that. Now, the whole thing of changing, y'all noticed last year our classes were 6-figure business building, or maybe 2 years ago, and now they're 7-figure business building. And that leads me to the next question, because the next question is came from our coaching, our group coaching this past Tuesday. So every first Tuesday at 11 o'clock Central for about an hour, we do a group coaching call. And if you're subscribed to that, if you're not subscribed to that, you can go to jjclink.com/group, and you can get access to the group coaching. And one of the questions someone asked is, hey, I feel led to empower people financially, but I'm not there yet. I'm rebuilding my life. This person had a lot of life happen. Sometimes life happens. And when it happens, it happens hard. And so this person had a lot of life happen, and they wanted to help other people win with money, but they felt like it might be hypocritical. And so they asked me, how do you do a business where you're helping people like that, and you don't, and is that hypocritical to help people while you're still getting out of debt, while you're still doing that? And I'm like, of course not. In fact, most of the Ramsey coaches that I started off with were in debt when they started the process. Guess what? Helping other people get out of debt helped them get out of debt. So I'm all about using that knowledge. If you have a gift to teach, use that and let that translate your intellectual abundance into physical abundance. And you say, well, I can't help people. Well, I don't pretend to be anybody I'm not. I don't pretend to be anybody I'm not. I'm very open about my story, and I love certain aspects of my story. There's still some things I'm trying to work on and work out. And, over time, I think my story has softened a little bit. I've stopped blaming my ex for all the things that happened, although a lot of it was his fault. I got to take ownership that some of it was my fault too, that resulted in me being in $845,000 in debt, right? But I didn't say, oh, well, I'm $845,000 in debt. I can't teach people how to get out of debt until I get out of all that debt. Because you know what? That was a 14-year journey. I thought it was going to be a 12-year journey. And some of you who've heard my pandemic courses, I thought I was going to be out of debt because I was selling the house, and then the deal kept falling through. But I kept thinking I was going to sell it. And I figured by the time the thing aired, it would be sold. So I'd be able to really claim I'm debt free, right? So that was a long process. If I waited around until I was debt free to teach people how to get out of debt, I wasn't ever going to be able to get debt free. And the good thing for me is I had already tasted what it was like to be debt free before I introduced all that real estate debt into my life. And so when I look at it, it's like, no, it's not hypocritical. Now if you're trying to teach somebody how to play, if you're trying to coach somebody how to win a gymnastics gold medal, you ought to have some experience in the sport, right? But you don't have to. You don't have to win a gold medal to be able to teach somebody what they need to do, right? Like a lot of the people that poured into my son for football and basketball and wrestling and all those things, those were people who had affinity and experience with the sport, right? That's a natural thing. However, you can have somebody who's not a star football player, but is good at football analysis and is good with mechanics of the body, coach you on how to get better at football. Because a lot of getting better at anything is about the fundamentals. And you may be working on getting out of debt, but you can coach people on the fundamentals that help them get out of debt. Similarly with relationships. Although I must say, I find it very interesting that a lot of relationship gurus are divorced and not remarried. I'm like, how you gonna help me find a mate and you don't have one yourself? That always does kind of bother me a little bit, but that doesn't mean they didn't have good things to say. And I'm happily married, so I guess some of their advice worked, right? But there's a lot of areas where it does help to have that expertise. But the great thing about coaching, and coaching is a fantastic skill. I'd love to talk to you more about the skill of coaching. In fact, maybe we'll make that, I don't know. I always say this with every topic. Maybe we'll make that the subject of our next group session, if enough people are interested. But coaching somebody isn't the same as teaching somebody. And coaching in the business world is not the same as coaching in the sports world. See, in the business world and in the personal growth world, when I'm coaching, I'm helping you draw out the answers from yourself. When I'm teaching, I'm sharing my knowledge. When I'm mentoring, I might be shortening your learning curve by sharing knowledge applicable to what it is we're doing. And if I'm advocating on your behalf, then I'm opening up doors for you. But those aren't coaching. Coaching is me asking you the right question at the right time in the right place to help draw out of you your next best step. And when I'm coaching, a big part of coaching is holding the other person accountable. So if you look at coaching in those definitions, then almost anyone with a knack for asking the right question to draw out of somebody the solutions they already know are in them, well, then you can pretty much anybody can coach anything and still be walking in integrity. All right, that was a great question too. Here's another one that really breaks my heart. Now, this is a person that came to me and offered to take me to lunch, and I love those kinds of lunches. When someone says, "Hey, can I take you to lunch and pick your brain a little bit?" I'm still at the level where you can do that. I'm a little too highfalutin to keep giving away everything free. When people ask me too much free advice, I'm like, "Come to my Thursday class and ask it live or in the comments. Help me. Like if I'm going to help you, help me build my business by participating in my free stuff, right?" But this one was one that somebody took me to lunch, and I thought I would share it with y'all because it really broke my heart. And what broke my heart is this person was retired on fixed income, and the interest rates are ridiculous right now. A lot of things aren't what they need to be. And so money's tight. The cost of food is tripled in some markets and everything else is just ridiculous. And so they were really feeling the pinch. And they started talking about how the bank was making it so easy to refinance their house. And they've never seen a process so easy. And all they had to do was click, 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 and it would be done. And they just wanted to kind of run it by me. And the reason it broke my heart is because when the bank makes anything easy for you, your spidey senses should go off and be like, boom, wait a second, what's going on here? What's going on here? Beep, 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 danger, danger, Will Robinson. Something is going on, right? And whenever the bank makes anything easy for you, they're making it easy for them to take your money out of your pocket. And a lot of times these refinances, I want you to understand what's happening in a lot of them, okay? So in a lot of refinances, there's several things that can happen. One thing that can happen is they could simply refinance what you have with a different loan term now that you've taken down your equity. Now, if you've paid down 20% or more, wait a second, I didn't say that right. If you have 20% or more equity in your house, you've paid it down long enough that you have 20% or more equity in your house, you will want a recalculation or a removal of the PMI or some kind of something with the bank so that they can take that PMI payment off, okay? And so that's one thing that the banks will do for you. And when it comes to refinancing the entire house, here's what they're doing a lot of times. You done paid on this house for 20 years. You got 10 years left of paying on it, and it's yours free and clear. And you decide to refinance, and they get that payment down low, 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 low. They get that payment down so nice and low, and you think, oh, this is the Lord. I'm so excited. But what they've done is they have extended your loan term. So they got you a low price. But they're extending your loan term. It's like, well, it doesn't matter if they extend my loan term. Yes, because of the amortized loan. Go type it in a mortgage calculator. Now you're paying them extra. And what's worse is some people get an extended loan time and an increased total loan. So like this person who came to me, the bank was going to refinance and they was going to give them a little money to pay off their debts and everything like that. And I'm like, first of all, you don't want to amortize and pay off on a mortgage at those rates for 30 years off on a debt that you could just work hard and pay off, right? Because now instead of paying $10,000 for that debt, you're going to end up over time paying like $50,000 for that debt. And that's, I'd rather put that extra 40 in my pocket, not the bank's, right? But what they were doing is they were giving them another 30-year loan. So now this person was going to have another 30 years of payments. They were not going to outlive their payments, which means they're not going to be able to leave that house free and clear to their children. And unless they have enough insurance to cover the mortgage, chances are that house isn't going to them at all. And a good man leaves an inheritance to their children's children. leaves an inheritance. We need to learn to leave something other than debt. And as one of my guest podcasters, his name's not coming to my mind at this moment. I am quite tired, but he said you need to learn to leave a legacy, not a mess. and so this really the part of it that broke my heart is I recommended against doing this. I was like, you have only a few more years left to pay off your house, and the money that they're going to give you was not anything that they couldn't have done themselves to pay down their debt. But what they wanted was the convenience of an easy, simple one payment. And despite my protests, they went away from that lunch, prayed and thought and calculated and listened to the bank some more, and came back and told me, thank you so much for telling us to take the refi. We took the refi. And I'm like, I didn't tell you to take that. I was against you taking that. I hope it works out for them, but it makes me feel really, really, really sad. So just to keep that warning, if the bank's making it really easy for you to do something, you kind of need to slow your roll, pull up the brakes, and wonder why. Okay. All right. This last one is a common one that I get in spaces that know Dave Ramsey. As y'all know, I'm a Ramsey preferred coach. And so I'm also a John Maxwell executive director. And I use a lot of John Maxwell leadership principles in my financial coaching. Well, this question comes up a lot with the financial side of the house because Dave Ramsey's first recommendation is to get together $1,000 emergency fund. And everybody's like, well, that's not enough. That's not enough. That's not enough. And I'm like, have you done it? Because if you did it, you would realize, of course, it's not enough, but it is enough to do what it's set out to do. It is enough to do what it has set out to do. It is enough to do what the point is behind setting up the account. That $1,000 may not cover a water main break, and it may not cover replacing your air conditioning, and it may not cover all the cost of a new water heater. It may not cover replacing your dryer or getting your car repaired if something happens and you need to get to work, right? But the thing is that most Americans can't even afford a $400 emergency. And by saving $1,000, you have not only broken that mold, but you have also set yourself ahead energetically as someone who cares enough about their future to save for it. See, we say a lot of things and we think a lot of things and we wish a lot of things, but we don't do a lot of things. And those of us who do a lot of things, if we'll be honest with ourselves, a lot of what we're doing is busy work designed to fill the void that's left by not doing the things we're supposed to be doing. All right. And so when you save that $1,000, that first $1,000, and I'm not gonna be mad at you if you save more. In fact, I have a client in a very high income area, and I recommended they save about 1 month's salary or one month's take home pay, which for them is like $17,000. So they're like, what? You don't want us to just drop down to the baby fund, the baby emergency fund, and put the rest towards debt? I'm like, y'all are a dual income family in a volatile place in a high income area. I'm going to need you to have enough savings that if one of y'all loses your job, there's peace in the household, right? But that's different for everybody. So what do I recommend as far as a savings account for everybody? Well, a lot of times for a basic family just going through their basic thing, I recommend starting off, like Dave Ramsey says, with that $1,000. You will come back and add more to it later when you're out of debt. But just having that $1,000 is a huge padding for most of the emergencies that come up in our lives these days. Like I said, it's not going to handle the water heater or the air conditioning unit, but those things would definitely require a little bit more. But those aren't the things that we're trying to inoculate against in this stage. Okay. So I recommend everybody does that $1,000 initially. And then after you get out of debt, I recommend that people put 3 to 6. And even like during the pandemic, I don't know if y'all remember it, during my pandemic videos, if you already had a 3-month savings, I was recommending you bump it up to 6. If you had 6-month savings, I was recommending you bump it up to 12 because we just didn't know what was going to happen. And in fact, if you're watching me today, I want you to know I went to that Good Friday service at one of my friends' churches, and they were wiping everything down and sanitizing and stuff. And I asked my friend about it, and she said, well, they had somebody come through who is a member of that church who works at the CDC, and they are predicting another big COVID style infection. And I don't know what it's going to be, and I don't know when it's going to hit. And that's what she kind of relayed to me, that nobody knows what it's going to be or when it's going to hit, but it's going to be in that same family and it's going to be nasty. So I'm not medical. I can't make those kinds of predictions with great confidence in the prediction. But if I'm telling you what I heard from a friend, and not only did I hear it from a friend of a friend, but those people took it so seriously that they literally sprayed and wiped everything down between every single speaker. So something might be coming, and we want to make sure that we are protecting ourselves with adequate savings. Now, if you're below poverty, I'm sorry. I can feel it. It's 11:30 where I live, and I've been up since 2, so I need to get to bed soon. But if you're below poverty level, then maybe start off with a $400 or $500 baby fund. But still, if you're below poverty level, chances are you're not used to actually saving. And this is a muscle that has to be developed, has to be flexed, has to be used. And so just that $500, if you're below poverty level, just saving $500 can be life-changing for you. And it's not just about the amount, it's about guarding that amount from all of the other competing priorities that want that money. So below poverty level, $500. Everybody else, at least $1,000. If you have it, if you're not in deep debt and you're just trying to follow along financial principles, maybe you would bump that up to more. You want to eventually bump it up to 3 to 6 months. Okay. And then, or maybe even 12 months. And then you'll have what we call a fully funded emergency fund, which will be a wonderful, wonderful day. But don't try to make that day too early, and don't try to that didn't come out right. Don't make the day too early. What am I trying to say with that? Because that didn't come out right. I'm sorry, y'all. I don't think I'm going to take any other questions. I had a few more here that were submitted, but I can tell how tired I am, and I don't think I'm going to give you quality answers. But what I mean is you'll get there with the fund, with the emergency fund, but don't let these external feelings keep you from doing what you need to do. There's a story in the Bible about a great person, Naaman, I believe his name was, and he came to the prophet. He was a leper. He was Pharaoh's second in command, but he was also a leper. And so he came to Elijah, I think it was, and asked for prayer. And not only did the prophet not speak to this dude, but the prophet sent a servant to go tell him, go bathe in the dirty water of the Jordan. I mean, they probably didn't say it like that. Go bathe in the water of the Jordan 7 times. And that water was nasty and icky. So the highfalutin guy didn't want to do it. The guy with leprosy didn't want to do it. But one of his servants said, well, sir, if he told you to do some great, amazing thing, you would go do what it took to do it. So why not do this little thing that he's telling you to do? And that's what I'm encouraging you to do today. Do the little thing and see if it doesn't change your energy and your attitude about money. And then get out of debt and then do the bigger, fully funded emergency fund. All righty. I think that is all I'm going to have for you today. I hope you've enjoyed this time. And if you have questions that I didn't answer, because I am ending a little earlier than I normally would, but that's because I started like 2 hours later because of the time zones and the wedding and all the things. I really do appreciate you for watching. And if you need anything, if you have any questions that you didn't get a chance to ask, go ahead and drop them in the chat or send them to me via a direct message. Now, let's be real. I'm traveling. I'm probably not getting to all my direct messages in a timely, immediate manner. Okay. The most immediate is if you put a comment on this video, and then I can see that right away and answer that right away. All right, that's all I have for you today. I think we're going to make this a part of a Wealth Building Wednesday. We used to do that. These Thursday classes used to become our podcast. And so this would be so normally it would have started off saying, hey, welcome to Wealth Building Wednesday. And I stopped doing that because, well, it wasn't Wednesday. But I wanted to get the recording. I wanted to get it recording me saying Wealth Building Wednesday or Mindset Monday. Get the recording so I could put it into the podcast. And we are finally starting to release. We found so many episodes that had never been put out, that they've been recorded, they've been, edited. They were like either missing an episode number, or they were missing some small thing. And with all these flights, I've been on the airplane fixing the things, and then I've had some help, production help fixing the things, and we've got a ton of shows that are coming out to the podcast. I'm so excited about that. And once we get all those previous recordings out, then we're going to officially rebrand. But I'm so excited that you're here walking with me in this journey. I hope you're excited to be here too. And I really do appreciate you. That's all I have for you today. Y'all take care and be blessed.